Imagine a Saudi SME with strong potential but almost no formal credit history. Could AI, guided by Sharia principles, fairly evaluate its risk and unlock financing? In this module, you'll shape that kind of system, rigorous enough for a PhD, yet practical enough for real banks to deploy. Saudi Arabia wants SMEs to power diversification and job creation. Yet many healthy asset-light businesses still get turned down by banks. Your PhD research will explore how AI can safely close this missing middle credit gap, expanding access without compromising stability or Sharia compliance. Traditional credit scoring was built for large, established firms, not young Saudi SMEs. Many small businesses have thin financial files, so models simply lack solid history to learn from. They're also penalized for limited collateral. On top of that, manual underwriting remains slow, costly, and inconsistent across loan officers. In this setting, credit scoring isn't just a technical optimization problem. Each stakeholder has a different success metric, and your design must balance them. Banks want accurate risk estimates and portfolio stability. SMEs need fast, fair access to capital. Regulators focus on prudential controls and data privacy, while Sharia boards insist on compliance, ethics, and no gharar. A strong blueprint makes these goals explicit as system requirements and evaluation criteria. For Islamic fintech, Sharia is the starting point, not an add-on. Credit scoring models must avoid interest-based logic, keep contracts and assumptions free from excessive uncertainty, and screen out prohibited activities. They also need to stay transparent enough that regulators, Sharia boards, and SMEs can understand and trust each decision. When we choose modeling approaches for SME credit scoring, we face a familiar trade-off. Simple models like logistic regression are straightforward to explain to bankers, regulators, and Sharia boards, but they often miss subtle nonlinear patterns in noisy transaction data. Deep learning can capture those patterns and leverage rich alternative data, yet behaves like a black box, making Sharia-aligned transparency and justification far more challenging. To make deep learning acceptable in a Sharia-compliant context, we have to open that black box. Explainable AI tools such as SHAP and Lime show why a model approved or rejected a customer by breaking each prediction into human-readable factors. This gives banks, regulators, and Sharia boards genuine visibility into the drivers of every decision. An architecture like this separates concerns so each layer can evolve independently. Raw bank, POS, and utility data flow into the ML scoring layer, which produces risk and eligibility scores. A Sharia rules engine then checks those scores against product-specific constraints. On top of that, XAI tools like SHAP and Lime translate model behavior into clear reasoning, presented through dashboards or APIs to loan officers and partner systems. In Sharia-compliant credit scoring, the fuel is much richer than historical bank statements alone. We augment the model with real-time POS cash flows, Sadad and e-commerce transactions, plus invoice data that better reflects day-to-day SME activity. Before any of this reaches the model, a Sharia screening layer strips out revenue linked to prohibited sectors or contracts, producing cleaner, compliant features that still capture the value of alternative data. You can think of this pipeline as the engine behind any serious PhD project. First, pre-processing transforms raw inputs into meaningful signals, like cash flow stability, while handling missing values. Next, you experiment with models, comparing, for example, gradient boosting to deep learning on the same tasks. Then, validation tests accuracy and fairness across Saudi segments and sectors. Finally, deployment adds MLOps, versioning, and safe rollback, so your research models can survive and adapt in production environments. Here's what explainability looks like in practice. The SME's short credit history slightly pulls its score down. In contrast, stable POS cash flow strongly pushes it up, and positive growth in the coffee sector adds further support. The model recommends loan approved, and auditors can clearly see that the decision rests on real business fundamentals rather than speculation. Now we move from models and data to the human interface. The loan officer dashboard is where AI outputs turn into actions: approve, reject, or escalate. Well-designed screens surface explanations clearly, support Sharia review, and still keep final authority with experienced human experts. At this stage, the research focus shifts to how components work together. The AI scoring engine exposes REST or GraphQL APIs, which the core banking sandbox calls whenever a loan application changes status. Each approval, rejection, and Sharia review decision is then recorded as an immutable log entry on a blockchain, giving regulators and Sharia boards a tamper-evident audit trail without modifying live production banking systems. Think of your PhD blueprint as a staged journey. Begin with a tightly scoped pilot, for example, a single Jazan SME or hospital segment, to de-risk data, models, and deployment. In parallel, put governance in place: Sharia review, risk controls, ethics, and data protection. Once this foundation is stable, you can scale, plug into national platforms like open banking, and design sector-specific scorecards that policymakers and banks can rely on. You've now seen how explainable deep learning can help unlock credit for Saudi SMEs, especially those in the missing middle. The real opportunity lies in designing systems that both banks and Sharia boards can trust. Use these architectural blueprints as starting points for impactful Vision 2030 research that moves from theory into practice.